Let's now focus on the economy and the GDP figures for financial year 2023, and quarter four financial year 2023 are out and they are beating estimates this time. The GDP growth rate for financial year 2023 is estimated at 7.2% according to the provisional estimates made by the government, and that's higher than the 7% estimate that the government had made in the month of February. If we talk about the quarterly GDP growth rate, that's at 6.1%, which is higher than the 5.9% estimate that the Reserve Bank of India had made. This is also higher than the 4.5% GDP growth rate that was reported in quarter three. So the GDP growth rate for the Jan to March quarter is at 6.1%, while the annual GDP for financial year 2023 is estimated at 7.2%. Now, to decode these numbers and understand their impact on our economy, we have experts joining us. Mr. Santosh Mehrotra, who is a senior economist, and we also have Professor Apurva Javadekar, who is an assistant professor of finance at the Indian School of Business and former research director at CAFRAL, the Reserve Bank of India. Apurva, thanks very much for joining us. So when we look at the numbers, they do seem positive at the outset, don't they? Both financial year 2023 overall figures and quarter four figures both beating estimates. What do you think are the primary reasons for that?
Two reasons, and this is a commendable set of numbers to have when actually global economy is slowing down. Two primary reasons for estimates which have come in surprisingly positively. One is that capex, or the capital formation numbers, are very strong, and on yearly basis they are growing at roughly 11 to 12%. On quarterly basis, last quarter they have grown around 8-9%. So capital formation, both government as well as private sector, is strong. Consumption has been weak actually. Consumption growth has been 2 to 3%, which is weaker. However, capex has taken most of the burden. If you look at industrial growth, then construction, finance, banking, as well as tourism and hotels trade has grown tremendously, both last quarter as well as over the full year. So those are the main contributors, one would say, to our growth numbers. And this is commendable, especially because in spite of high interest rate environment that has prevailed over last year, corporates and firms are still investing. They are borrowing very strongly and they're investing in the capex plans. So that bodes well for future growth as well.
Right. So those are the primary reasons contributing to the growth. And if we also look at the figures, we've seen that manufacturing sector, which had contracted last time in the last quarter, year on year, now the manufacturing sector is also growing. So sector-wise, which sectors do you think are contributing to the growth the most? Of course, you must have seen the fine print as well.
So one must understand that manufacturing is most sensitive sector to the interest rate environment. So when Reserve Bank increases the interest rate, that's the sector that's going to slow down the most. So you would expect Q3 numbers, Q2 numbers for manufacturing to slow down. Even now, if you look at manufacturing has grown over last quarter by just 1% like in between 1 to 2%, so which is slower compared to other sectors. However, it is in the recovery mode. And capex is growing, companies are investing. That means they must be expecting some good order book to follow in next couple of quarters. Capacity utilization is higher. All those are leading indicators of growth to come.
Right. In fact, if I look at the manufacturing figures for the financial year 2023, the growth rate is 1.3%, which is, in fact, the lowest among all sectors that we're looking at. The highest growth has been reported in the sector of trade, hotels and transport, the sector that was hit the most during the pandemic. So now that we talk about a GDP of around $3.5 trillion US, in rupee terms, the GDP is around 270 lakh crore rupees, the nominal GDP that we're talking about. So $3.5 trillion in financial year 2023. Where do you think this leads us to for the $5 trillion economy by the year 2027? To achieve that, we would need a growth rate of around 10% every year for the next 4 years to be able to reach that target.
So achieving nominal GDP growth target, you can achieve it either by having higher real growth or by having higher inflation. And I think India is on track to achieve good growth. By good growth, I mean good real growth rather than just a growth driven by inflation, right? So our inflation numbers are back to 5%. and low inflation is very important to have long run growth spell of growth numbers of 7 to 8%. I think 10% is a little bit out of reach, if you ask me frankly. However, I think looking at some of the indicators now and the fact that inflation is low, looking at the historical episodes of other emerging markets when they have had low inflation, I think we are good for next 5 to 7 years of a good growth spell. So I cannot put an exact yearly timeline in terms of when we would reach 5 trillion economy, but I think we are on good trajectory, good growth trajectory.
But you're saying that 10% seems out of reach, but we're talking about nominal GDP growth here, right? And
yes,
this year we've seen the nominal GDP has grown by around 16%.
16%.
So
yes.
do you think...
So on nominal basis, so if you add up inflation and real, I think we are going to have growth rate of roughly 12% on sustainable basis over next 5 to 7 years. But you can have 12% growth rate in nominal GDP by having 10% inflation and 2% real growth. That's not a good target to have. So we need to be more concerned about the breakup of the nominal growth rather than just the target of 5 trillion economy. We want to reach there in a healthy manner.
Right. And
rather than in a timely manner.
Right. And now when we look at how we've recovered from the pandemic, Apurva, if we look at the nominal GDP of the country, but of course you have to include inflation there as well. But in 2019, our nominal GDP was around 188 lakh crore. Now it has come to 272 lakh crore. But in real terms, if you compare it, our real GDP, according to the figures released by the government, the real GDP is at 160 lakh crore, while in financial year 2021, it was at 136 lakh crore. So when we compare it with the pandemic, according to your assessment of the figures, have we recovered entirely from the pandemic impact and also from the impact of the Russia-Ukraine war? Have all sectors fully recovered?
So on broad aggregate basis, I think we have recovered. Most of the losses in GDP that were made, at least on paper, they are back. It cannot be that all the sectors have recovered equally. Contact-based services, trade, tourism had suffered significantly more. So we are seeing a lot of momentum and a lot of catch-up happening in those sectors. By the time we recovered, now the interest rates are higher. So some of the lost manufacturing ground will take longer to recover. And especially exports, we would have liked exports to kick in way faster, but by that time we are out of pandemic, the global growth is slowing down. And so therefore some sectors are going to take a couple more years to recover fully in terms of we are yet not back on where we would have been if pandemic would not have happened. It's just that pandemic happened and now we are back at pandemic and slightly above that. But overall, I think on aggregate basis, we are on good trajectory, and most of the sectors are in positive. Construction, especially, construction has construction has grown, I think, strongly over the last couple of years. Those are good signs.
All right. We also have Mr. Santosh Mehrotra now joining us, who's a senior economist. And Mr. Mehrotra, your first take, the figures are above estimate, both the financial year 2023 provisional estimates and also the estimates for Q4 financial year 2023. So your first take on that, do you take these as above estimates figures, they're positive? And what do you think are the reasons contributing to the numbers beating estimates?
Well, it's certainly good news that the growth rate is somewhat better than in the previous estimate. But please remember, this is only still the third estimate.
Right.
There will be a fourth and final estimate. And the revisions are all constantly taking place. And revisions can be downwards as well as upwards. That's point one. Point two, that the economy was slowing before COVID, and if you take into account the 3 years since FY20, meaning including COVID, FY21, FY22, FY23, and these latest figures are for FY23, you get an average growth rate of somewhere between 2.6 and 3%. So what has happened is that we went down very sharply. We had the worst contraction among most countries in the world. When the global economy contracted by 3.1%, our economy contracted by 6.6% in FY21. So we have seen a rebound. Now we have to see whether in FY24 we are going to sustain this kind of 7%. No one in their right mind is projecting for FY24, 7% or even 6.5%. Most people are projecting in the region of 6%.
Yeah.
And the main reason for that is that consumption has revived, but barely revived just above the per capita consumption level of FY20. Why are we surprised by that? Because joblessness has increased dramatically by the government's own estimates. I'm not talking about the CMIE estimates, by the government's own estimates. The absolute number of unemployed people in the economy in FY22 was 10 million. It had gone up to 30 million, 3 times before COVID, and another 8 odd million have been added during COVID. And obviously, when joblessness increases and the employment rate fell, we know that the employment rate has been consistently falling since 2016, thanks to the demonetization and other stupid policy mistakes. We have seen that inevitably people's consumption cannot rise. And consumption is nearly 60% of total GDP. So how do you expect this to be sustained? And especially at a time when investment to GDP has only just revived to 29% after having fallen 27%. Private investment is not picking up. Public investment is what has brought the investment to GDP up to 29% in FY23.
Right, that's very interesting to note. And Professor Mehrotra, if I can get your take on this, that what were the factors, according to you, that have contributed to this GDP growth that is beating estimates? What do you think are the sectors? Of course, you would have read the fine print as well. What are the sectors that would have contributed, and which expenditure part of the GDP is?
Apurva mentioned some sectors, and it is true that in certain modern services sectors, those have revived. Tourism, hotels, restaurants, that has revived. Construction has certainly revived. There is only some uptick in organized manufacturing, but in unorganized manufacturing, which accounts for most of the jobs, which is where the most of the consumption is going to come from, has not revived. So broadly, it's been a K-shaped recovery, where broadly the organized sector has recovered, but the unorganized sector is still reeling from the multiple shocks of first the demonetization, then the GST badly planned and poorly implemented, and then the lockdowns and the poor economic policy decisions over that period. So unfortunately, what we've seen as a result is that profits have gone up, as the Morgan Stanley report is repeatedly reminding us today. And yet at the same time, input costs have fallen because jobs have fallen. So you see, this is not a happy situation for sustaining GDP growth. Please remember that if we want to grow at nothing short of 7% per annum. After all, we are the poorest economy among the G20 countries. If we want to sustain growth at 7%, and that's the only way we are going to actually reach the $5 trillion economy goal, then we have to actually ensure investment rises and consumption rises, which is not showing the kind of buoyancy that we would like to see happen.
Right. All right, gentlemen, thanks very much for joining us and breaking down those numbers of the GDP for us. And as Professor Mehrotra and Apurva both mentioned, that the numbers are definitely positive, good news for the economy. But on the other hand, there are some pain points for the Indian economy that remain, including joblessness, unemployment. But the GDP figures definitely beating estimates.